Hello, everyone, and welcome back to our 10th episode of the Winnipeg Market Watch podcast. Today, I am very happy to be joined by a good friend and local real estate investor, Taylor Keast, and as always, my co-host, Denzel Sullivan. How are you guys this morning?
Good,
All
good. Thanks
good.
for having me. Appreciate it.
Oh yeah,
Awesome.
all good over here. Got the coffee, my bottle of water. I'm good to go.
Love to hear it. There's nothing like sipping a coffee and early morning podcast recording session with a whole month of data to break down. Folks, today we have the data from September 2024. And I think this month in particular is always one of my favorite months to analyze the data because it's the end of the third quarter of the year. And traditionally speaking, Q4 is usually the slowest month of Winnipeg real estate. So I often use September data as a litmus test to see how the rest of the year is likely to play out into the slow winter months. And I think we're going to have a really cool discussion today just based on the different variables and factors that I've noticed in this data set. You guys ready to break it down?
Oh yeah.
Yeah, let's do it.
Excellent. So guys, first things first, let's talk about benchmark price. In September, the Winnipeg benchmark price was actually exactly flat from the previous month at 418,800, which is identical to the August data. That means that year to date, we remain up 10.24%, and we are only 0.66% from the 2024 high and negative 2.4% from the all-time high, which was in 2022. Now, in the article, and based on the discussions that we've had kind of off of the camera here, there's a lot of reasons that this likely could have happened, but I want to hear from both of you, and I'm going to let Taylor go first here. Is this what you guys expected, or did you think we were going to slide more going into this fourth quarter here?
I would have expected us to slide a little more if it wasn't for our kind of rate environment right now. I think the Fed cutting 50 basis points and then, Bank of Canada looking like we're going to get another big cut. I think that helps a little bit, helps affordability, kind of brings a little more activity in the market. So I'm with the rate cuts, it's kind of as expected, but I really started the year, I really wouldn't have been able to tell where we're going right now.
Fair enough. Denzel, any thoughts on the matter?
Yeah, it's kind of interesting that we haven't had. Well, first of all, I think that it's interesting that we were flat. Like generally speaking, like if we even go back to last year, September was a down month, if I can't remember, like last year in terms of the benchmark price. So I think that this is just something to consider that people in Winnipeg are not not hung up on price as much as they were in previous years. They're just kind of accepting for what the market is at this present time. And I actually see that there's quite a bit of activity. Like me and Keenan just recently had a house for sale in the west end of Winnipeg, and we were, sub 300 on the list price, but we were pretty busy in terms of showings, I would say. I think we maybe had Keenan is probably like what, eight showings before the open house, and then you said something like 30 groups through it or something
We
like
had
that.
we ended
Yeah.
up with 10 showings before the offer date, but we had one of the busiest open houses I've had in a very long time, actually. Where, yes, I lost track, but there was at least 30 families
Yeah,
through it.
so
And the chaotic part was they weren't like groups of one, it was groups of like five. And this was 1,000 square feet. So you can
yeah,
imagine how that felt. But go ahead, like
yeah,
continue.
so like buyers are out. Yeah, buyers are out there, I think, and so they're what's keeping that price, that benchmark price where it's at right now. Like I had another friend of mine, also an investor and flipper, and he just listed a house. I don't know if it was an offer date situation or if it was offers as received, but he sold and he was listed at 299, small little 800 square foot 1930s bungalow, 3 bedrooms, 2 bathrooms. And I don't even think he had it on the market for 3 days and it sold over ask. So there's definitely an appetite out there for property still, even with it is a little bit cooler now. It's getting there. Winter is coming. And I mean, I don't know. I'm interested to see how the rest of October plays out because there's a few more houses that I need to sell. So yeah.
Yeah. Well, that's a really great answer, and I love the detail in all of that with just the anecdotal stories of how different houses at different price points sell. I find very valuable for my own business, especially when it comes to pricing listings and gauging activity at different dollar value price points. But another thing that I think is maybe not on the forefront of anyone's mind in Winnipeg, but geopolitically is kind of a big thing, is the last 30 days have had almost a full year's worth of political drama, all of which could very likely result in some pretty wild interest rate decisions being made, including the dissolution of the NDP Liberal coalition at the federal government level, which resulted in two subsequently rejected non-confidence votes. Obviously, as Taylor alluded to, there was the half-point cut by the US Federal Reserve, alongside, of course, the obvious upcoming presidential election less than a month away now. I wrote in the article that it's my opinion that all of these things are actually pretty likely to result in both US and Canadian rate cuts to occur eventually for one reason or the other. But I do think it's pretty funny that even with all this chaos going on in the world, and not to mention the Middle East conflict as well is something that is happening, we still have buyers out there willing to hand out $300,000, $400,000 for houses in little old Winnipeg like it's 2022 again.
Yeah, I agree 100%.
So very cool to see that. As for the supply picture, I think this is where things get really interesting to me, because the last 2 years, we ended up with what I would consider to be a small glut of supply hitting the market towards the end of the year, and stuff tended to sit. And I remember both anecdotally and from looking at the data, I had listings in August, September, October in 2022 and 2023 that were really, really tough to move. And this year, I was pretty pleasantly surprised to see we had 10% more number of sales in terms of like overall volume of transactions occurring, but there's actually about 10% fewer active homes on the market right now. Did you guys feel that trading in the market this last month?
Mm, It was a little bit hard for me to notice. Personally, I've actually been spending a lot of time like wholesaling and doing a lot of assignments like in the past 30 to 45 days. Um, and so while because who I deal with is a lot of investor buyers, right? In that space when it comes to wholesaling. And it's almost as if as long as it's a good deal, the buyers are always there for it. I think that it's just like last year, a little bit more challenging. You have to work a little bit more harder to move a contract in the case of a wholesale deal. But yeah, it's hard for me to gauge on the retail side because I'm not like you, Keenan, a
Yeah.
realtor. But yeah, that's my take on it.
Yeah, I've noticed a lot more. Typically after Labor Day, you kind of get a lot more offers as received listings. But this year, it seems like there's still a lot of offers dates on, properties that aren't necessarily priced for a bidding war. They're just, I think there's just so much demand that the market's kind of stayed, absorption's still pretty high at this time of year, which is interesting to see.
Oh, there is one thing that I'd say though. Just this is
Mhm.
more not so much towards the supply picture, but more on like just price. I do think that there is a limit in which people will pay over asking in terms of like a offer date situation. I think like again, we just recently sold a property. We sold it over asking price, but it wasn't like a blowout. Um,
Mhm.
and it's been a while since I've tracked sales in certain areas, but I'm seeing less and less um like really outlier type prices on things. I don't know, Keenan, have you noticed that too? Like I don't know. You have a lot more access to more of the data, but I just feel like it's not as crazy as the spring market, but it is happening.
I've seen both, and it's definitely on a product by product basis. And for what it's worth, I'm finding that the really cool, like darling houses where somebody really went above and beyond and is selling a product that, you know, economically speaking, it probably wasn't worth it to take it to the point that they took it to, but they liked it. So they put fits and finishings that an investor would never ever do, but it was a homeowner touch that they really, really loved and cared for, and the house was unique or special in one way or the other. Those I've seen go for crazy money that doesn't really make any sense on paper. But when it comes to more standard houses or flip houses or other type of normal home buyer property, I would agree. I'm not seeing people paying 50, 100, 150 grand over on that kind of thing anymore. And that's okay, because I do think that the market has generally recognized that. And the asking prices, as Taylor alluded to, have kind of caught up. And people are now pricing a lot closer to value than they might have been if they were listing in, say, February, March, or April. But we've talked about that on this podcast before, how the longer you wait to list and the further you go into the year, the more beneficial it is to list more in line with the higher side of the range of value, rather than putting it to the absolute bare minimum of what the property could be worth in an open market situation without being, dishonest or
Yeah.
doing something illegal,
Yeah.
But interesting that you point that out, because I have seen that a few times. But the total amount of homes that are selling like in blowouts, I agree. It's not something that typically happens at this time of year anyway.
Yeah, like it really takes like if you're a flipper and you're trying to go for that, because I do know a guy also who was flipping a house in Silver Heights recently, and yeah, he blew that out of the water. It was like 58 grand over the asking price, but he also
Nice.
spent like a lot of money on that thing. Like it it looked like there wasn't a part of the house he didn't renovate, and so
Hmm.
and in my experience, it's one of those things where you could get burned spending a lot of money because you don't know if the market's going to appreciate the money spent, right?
Of course.
And so I've had situations where while you spend a lot of money, all that will do isn't exactly a higher profit margin, but it'll just ensure that you will sell and sell faster, right? And I've also done less on houses and done really well. So it's really tough.
Like everything else, it's situational.
Exactly.
So,
Yeah.
exactly. Now let's talk about absorption for the entire Winnipeg market. And this is something that I found quite interesting. Is despite the overall higher transaction volume and the relative stability that we saw in terms of supply, we actually did move closer to a buyer's market in aggregate this past September, which is normal for the season. But what I thought was particularly worth noting is at this point in time, we are in a market that's behaving more similarly to the pre-2014 years that we had in Winnipeg, and less similarly to the pandemic or the 2015 through 2019 year range. What I mean by that, to be explicit, for those of you that don't have video or don't have the article in front of you, is we are actually more seller favored than we have been in quite a while, with the exception of 2020 and 2021.
Wow, look at
I,
that.
I think that's pretty impressive for the state of affairs that we're facing at this point in time, with rates still, despite them coming down a little bit, they're still quite high, especially compared to the pandemic years. But also the overall sentiment of the market in general seems to be that they understand that prices are high and that homes are expensive, but they're being bought anyway. Any comments on this data, either Taylor or Denzel?
I just think it's
Sure.
interesting. I mean, months of inventory being this low, um, I just wonder where that's going to go. Because it seems like we don't really have a whole lot of new supply coming on. There's obviously the resale market, but I don't know how much these builders are necessarily building these new communities right now. So I wonder if this is going to stay low, or if we'll have again as rates go down, maybe people think it's a better time to sell, start bringing more of their product to market, and start to bring that number up.
Good point. And honestly, I think especially once we get to the early stages of next year, where builders start listing their spec builds and start preparing development stuff, and those things come to market, and the homeowners who don't list in 2024 because they wanted to hold out over Christmas, which is really common, we'll have a pretty good feeling as to what the direction of supply in general is going to be like. And I definitely want to watch this as well, because I'm very curious to see how much supply are we going to build up towards the end of the year before things take their magical January 1st shift?
Yeah, I don't know. A couple months ago, I had said that what if there was a world where while the rates went down, you know, we traveled more into like a balance slash buyer's market because the problem right now is we were coming off of a time where during the pandemic, people were actually afraid to list their houses. The prices started to get out of control, and people were worried that one, if they sold, they weren't going to have a place to live after because pricing was so crazy. And two, obviously, because of the pandemic, people just didn't want other people in their house. Now we're coming off of that. And when I speak to people who aren't in real estate, there's not a whole lot of people talking about real estate, if that makes sense. Like I remember when in 2022, you talk to someone on the street and they're like, all about real estate. Yeah, I got to get an investment. Yeah, I need to buy a house, or the market's good right now. But then, you talk to someone now and they don't really say much about it. They're like, it doesn't really come up unless I ask or have something to say about real estate, in just my conversations with people daily. And so I don't know. I think maybe the next 3 months, the the supply could rise, and in the spring market in January, like we don't really know. Like I was expecting September to be a little bit more active than what it was. I'm not saying it was a bad month at all, but I'm just saying that whatever fall rush people were expecting to see, it's been it's been a little late. Like, couldn't you agree, Keenan? Like most people would say that, like, after the Labor Day weekend, it's people are back to school, back to work after the holidays, and they get more serious about buying, right? But
It can happen.
I don't know.
There's usually a last hurrah that occurs sometime between September 1st and, I say, Remembrance Day. Some people might move that date way up. Some people might kick that back a little bit. But either way, at some point in there will be a last push where the sellers will say, okay, if we're doing it this year, we're doing it now because we're not listing over Christmas. And a lot of the buyers will say, okay, if I'm doing this, I'm doing it now because I don't really want to move over the Christmas and New Year's week.
Yeah, like the last 6 weeks of the year is dead, in my opinion. We
Most
usually find some of the best deals during that time. Um, but yeah, I don't know. We'll have to see how the spring plays out. If I think it might actually be just like last year, where in October and November supply built up, everything that didn't sell during the winter carried over into January, and everyone was kind of nobody was listening in January, but if you had something to sell and it was good, it was going to do really good because there was nothing on the market.
Yeah, and we lived that actually a couple Januaries consecutively here, and we're hopefully going for a repeat performance in 2025 with at least one house. So
Yeah.
that'll be really fun to look out for. But I want to take this back to something that Taylor mentioned. I'm going to say a couple exchanges ago here, where he said he's noticed a lot of houses still selling for over list price compared to previous years, and the data does support that actually, with 34.5% of homes selling for over the asking price, 8% or so selling at list price, and 57% or so under list price. This is significantly more than we saw last year, where the combined of list or over was actually only 32%. So we're in a situation where the bidding war prevalence is way up from September 2023. And in fact, the data would indicate that the way the numbers look at the present moment, this September actually has about the same prevalence of multiple offers, or at least asking price offers, as we saw in a month like maybe March, or to some extent, you might even be able to say February, March, and April, although that would be kind of pushing it.
Mhm.
As an agent, I can say that I think this is a super personal decision as to where you want to set your asking price and if you want to aim for multiple offers or if you want to work backwards at a time like this. And I know I've had conversations with clients where their preference is to go one way or the other. And I don't think there's a wrong answer. But I'm going to start with Taylor here. If you had to sell a property right now, all other things being equal, as the owner and as the investor, what do you think would be in your head about pricing strategy for a listing this October, given the data that we've seen here?
It's a tough one to say. I think it depends on the product you have and the all around desirability. But for what we have, a lot of starter homes, I think I'd probably list pretty aggressively, but maybe on, about average of what the fair market value would be, but maybe with an offers date, try and get a bunch of eyes on it ahead of time and see if you can drive out some competition. But I don't think I'd list low with an offers date and take that chance. I also don't think I'd list way on the high end and then, ride it out, sit on the market for a month or two, cut the price a couple percent at a time and sit and wait. So I'd be somewhere in the middle, I think.
I think that's reasonable. And I feel like that answer probably, in my opinion, accurately captures the sentiment of most sellers in Winnipeg right now. But Denzel, we've obviously talked about this, not when we're on camera being recorded a few times, but what are your thoughts?
I think as a seller, there's a few things that you should consider. First of all, one, you want to know what are the other active listings that you're competing with when you do decide to go to the market. And then two, obviously analyze your current situation and kind of see what it's going to take for you to have success in terms of like what you're going to net out of a sale. And then three, what your timeline is. Like a lot of the time, for an investor like myself, there's a lot of holding costs involved. And so generating an offer quickly so that we can begin to negotiate is usually something that we are all, or what me and my investors are trying to accomplish, right? Because cash flow is very important, whether, we wait for 30 days to get the same offer or we can get the same or close to the same offer in a week is huge, right? Because that holding cost just eats up so much of the profit. And not to mention just the longer you sit on the market, you think of it as like you're like on a shelf and you're just collecting dust, right? And you don't want that as a seller. You want to be able to be one of the first choices and just be over and done with it. It's just, in my opinion, especially if you're running a business in real estate of trading property, it's important to just turn these things over, move on. If you don't get what you are hoping for, that's flipping real estate for you, and you just got to move on to the next deal. Because I see a lot of investors actually get hung up on price and they don't move with the market, and then they get stuck. And especially in a time like right now in Q4, like the last thing you want is to not sell, and then you're one of the listings carrying over into January and you're thinking that my house is still worth this, you know? So yeah, just I digress, but going back to pricing strategy really depends on your specific situation. I've done both this year, starting high, waiting for an offer, and then also starting a little bit lower and then generating an offer quickly. And I think while I haven't always gotten what I was hoping for, I'm much more happier being done with that deal, being able to shift my focus elsewhere than waiting for something to happen on a specific house.
Right. And that last sentence you said there, where I'd rather just be on to the next one. I think a big part of it is you got to gauge your sentiment like on a almost introspective basis as a seller, where you need to understand like, hey, do I want to sit here for 4 weeks, 8 weeks, maybe 10 weeks and wait for an offer and grind out reductions? Or if if you don't have the patience for that, or if you just think that it's going to be torturous to sit through it, then that's a factor too. And for those of you out there that are looking to sell, I think understanding that part of it within yourself is probably a really good thing to have a grasp of before you make a decision to say, well, the best house in this area sold for 600,000. My house is better. I want 650. And then, inevitably not selling for a long time. You know what I mean?
I think on the buy side, though, you can really take advantage of that. You realize that a seller, if they list and they're really optimistic and it starts sitting for a month, they start going, oh, is my house ever going to sell? What's it really worth? You can kind of come in there and be pretty aggressive on the buy side because you understand that it might be panicking a little bit, right? So
Yeah.
I found some of the best deals that you can buy on the MLS are those stale listings or listings where the seller might be a little worried. They might just want to get rid of it quickly now that it's sat for a while. So it kind of works both ways.
Yeah, Taylor starts licking his chops.
Yeah.
Oh yeah.
Oh yeah.
30 plus
Like,
days
yeah.
on market, aggressively priced. Yeah, that's great.
Like, yeah, these guys are getting desperate. Here comes the under
Here
50K
comes the
under
low
that.
ball.
I couldn't agree more. Like some of the best MLS deals I've seen are the following, where it's either the seller or the agent horribly mispriced the listing, made a big mistake, and then eventually the offer came in and it sold for a lot less than it would have. Or there's a situation where somebody made a play to list at a somewhat aggressive price, but maybe didn't take it far enough. Everyone passed, and then the day after the offer date, somebody picks it up for remarkably close to asking when it probably should have gone for a lot more. But the last one is the big one where somebody just for whatever reason can't draw an offer or rejects offers for months and months and then gives up and takes literally the only thing they can get. And so investors out there, especially as we head into this fourth quarter, I do think if you have the opportunity to find an MLS deal that maybe has been ignored by the market or people aren't paying attention to it anymore, have a hard look at those houses because you can often pick them up for a lot less than asking. And this is the time of year where nobody's going to be offended by your offer. As an agent who represents the sellers, if I have a stale listing and we receive a low ball, I'm going to the seller and I'm not saying, oh, hey, look what this guy brought. This sucks. I'm going there and I'm saying, hey, awesome news. We've got an offer. Let's see how high we can get them.
Yeah.
And that's how deals happen. That's the magic of this late Q4 time of year. But in a little bit of a transition here, let's talk about some of the hot areas for this last month, and let's see what's changed for the year-to-date absorption by area. Once again, we have a trend where all of the areas, starting with the number 3, which is Winnipeg's northeast, including North Kildonan, Elmwood, Fraser's Grove, Valley Gardens, East Kildonan, and the surrounding areas, all the way out to Transcona, have been absolutely piping hot this entire year. One of the big surprises to me is the Valley Gardens area, which is actually, for those of you who are not aware, it's a pretty small MLS area, very near Highway 59, adjacent to North Kildonan. I grew up very close to there. It had 100% absorption this month. And probably the second most surprising thing to me was 3B, which is the east side of Elmwood. It touches East Kildonan as well. Traditionally speaking, not considered one of the best areas, but it's very quickly changing, and that area is becoming very desirable. They're up to 90% absorption. And scrolling through the list here, guys, it looks like most of Winnipeg's sort of premier upper middle class suburb type areas. We're talking about the 5F, 5G, 5H, 4H, 4G. Those are Maples and the Westwood, Crestview, St. James, Silver Heights type areas. They're all performing. Now, we've talked about this a lot. What do you guys think? Are you surprised by any of this? Do you like the direction that this is going? And looking at this data, are you targeting certain areas to buy more so than you otherwise would have? Or are you avoiding certain areas that you might have been more interested in other times?
Denzel, why don't you start on this one? I want to hear your take on this.
Well, for me, my business model, I'm always looking for areas that have at least a minimum of 85% absorption rate. So if I were to get a lead in any one of these areas, I'm definitely thinking about buying seriously in that area. Or yeah, the there isn't too much here that surprises me because Keenan and I monitor this so closely all throughout the year. And so I'm pretty sure that we've had something almost in every MLS area so far year to date, whether it was just a lead that came through the pipeline or an actual house that we're attempting to sell. So in terms of areas that I'm looking to avoid, if there's a deal there, because I've flipped houses in Sinclair Park, in St. John's, in like the hardcore area of the West End in 5A. Like I've done it all, and I would do it again only under the assumption that we've gotten a great deal for that price and the risk is worth the reward. I think that when it comes to choosing an MLS area, here's something. it's a bit of an anomaly. And if you have a weird house though in one of these areas that have a high absorption rate, don't use the absorption rate as a way of thinking that you're like that's a good product to buy. Because I've seen some houses where, or some investors, sorry, they'll buy like, for example, in let's just say 5 Westwood. You know, in Westwood they have these some weird houses where they were like built in the 1920s, you know, little house, very uncommon type of property in that area, and they're really hard to comp out. I would probably myself steer clear of those. I've had a couple of those opportunities come to me this past month, and I pass on them because they're just too hard to analyze. Um, so that's my take on it. I think that all areas, anything above 85, I'm interested. Anything that's in the hardcore areas, I'm really thinking like, okay, we got to pick this up for like 30 grand or something like that in order for me to go and take that risk.
So what about the middling areas? Because there's a huge chunk of MLS areas right now that aren't quite at 85, but they're between, say, 70 and 85. And I'm talking about areas, for example, like 4C and 4D are good examples where they might be stigmatized or considered like not that good of an area, but
Mhm.
they've been chugging with pretty close to 80% virtually all year, and prices are still low. Do
Yeah.
you consider those areas as riskier to flip? Like they're not extremely ghetto, but they're not like premier. How do you feel about those neighborhoods?
It depends on the product. You know, if you're in Sinclair Park, you got a 1950s bungalow, then yeah, sure. Like all day, it doesn't matter if the absorption's less than 85. I know for a fact that that's like something that even if you aren't exactly crazy about the area, it's something that you do want and it's more affordable than everywhere else that you're looking, you know, then that makes sense. But you know, if you're buying a 1910 1.5 story and you're paying retail for it, like I probably wouldn't recommend that, right? And it
Right.
also is like street by street. There's like sub neighborhoods inside of these like MLS codes as well. That's something to consider. You know, like for example, in 4C, if you're anywhere near uh McPhillips, east of McPhillips or west of McPhillips, like those are all areas that I'm sure even Taylor would consider buying in just because of where it's located, right? A lot of um there's tons of newer families to Canada in those areas, and it's in that price point where a lot of people that I know are shopping in that neighborhood. So
True enough. Like 4C Main and Mountain is a lot different than 4C Inkster and McPhillips.
yeah, or
Yeah.
4C um St. John's, you know,
Yeah,
like it's a lot different.
100%. Any thoughts on the matter here, Taylor? I'd love to hear your take on this.
For me, it's interesting because I'm a buy and hold investor, so I'm not listing properties. So I kind of have the opposite take. Some of these markets, especially 5E, is a place we focus on a lot. And having an 85% absorption almost all year makes it pretty tough to find deals, at least on market. It's good for the properties you hold, but I kind of tend to look at, okay, what's getting a little less absorption that maybe isn't getting the same amount of attention. So again, markets like 4C, I think, is a pretty underrated area in terms of the quality of house you can buy for the price and general safety. I don't think 4C as an area is a whole lot worse than some parts of Elmwood or even some parts of Weston or some of these areas that aren't viewed the same way. So that's kind of what I'm looking for is when I'm looking at this, I don't see a lot of buying opportunities in a lot of these markets with higher absorption. So I have to look at it almost the opposite as what Denzel would look at it.
Fair enough. And that's probably a good thing to note that if you are a home buyer out there as opposed to an investor, well, the mantra goes, if it's easy to buy, it's hard to sell. If your time horizon is a very long time, by the time you're ready to sell, it could be the case that the market has totally changed and you might be in a lot more of a liquid situation than you would have been if you went to get out within 6 months of getting the keys. So Taylor, your perspective on that, very valuable as somebody that invests in a different way than Denzel and many others, where there's a lot of churn. And Denzel's at the lawyer's office almost chronically delivering keys, picking up new keys, signing papers, acquisition, dispossession, et cetera, et cetera.
Yeah.
Yeah, one more
Um,
thing I thought was
yeah,
interesting is again, I believe almost all these market regions, maybe all of them, have a price below 450. So it seems like all the hottest markets still this year are still in that more affordable price range below our benchmark price or right around it.
That is a good point to bring up. And in one of the previous articles that I wrote, which actually, Taylor, you gave me the idea to do this, which was to break down the MLS areas, their performance by certain timelines, and then analyze the overall absorption based on the price point that was going on. We did determine through that research that Winnipeg's best performing areas by almost every time frame would have been those areas roughly around the benchmark price or slightly, I guess I'm going to say 5 to 10% lower, up to 5 to 10% higher, and everything else underperformed. So for those of you out there looking for buy and holds, it seems like being somewhere in the middle is probably where you want to be if you want to capture performance in this city.
Or if you're interested in buy and holds, send me a DM and ask what I have on available right now.
Yes, you can always do that. We are big on the wholesale market here in Winnipeg, and Denzel is your ticket to that. He'll set you up. He's the plug for Winnipeg wholesale.
Yeah, there you go. If you're looking for off market stuff, send me a DM right now.
You love to hear it. Okay, well that is the market update here. Would we like to proceed with our interview of Mr. Taylor Keast, or would we like to have any closing thoughts on any of the data that we just went over here, guys?
Trying to think if there's really much to say about it. I think me personally, with everything said, I'm actually really happy with how September has gone. I just actually had a memory on Facebook of a video of me walking through a property that I sold on Mandalay last year. And first of all, the year just flew by, first thing. Second, going back to that time, man, was it ever chaotic.
Mm-hmm.
Like last year's fall market was just terrible. And I think it's hard for us. I started during the pandemic, so my baseline, and I spoke to you about this earlier this week, Keenan, my baseline, and Taylor, you probably have a similar one to me, is just chaos towards pricing being extremely hot all the time. There's no breaks. It's always crazy. Like that's how I started. And so now with getting used to seasonality and it being a real thing in real estate, it's definitely like a mental adjustment that I need to make for my business. So that's just my thoughts on September, at least.
Okay, fair enough.
Yeah.
Taylor, anything to add?
Yeah, just kind of touched on what Denzel said. I think from the pandemic, you can lose a little bit of perspective on risk and on how a normal market might perform. So there's a little bit of an adjustment period during, I guess, 22 and 23, where you kind of have to start looking at, what am I really buying? Is this actually a good deal? Am I just banking on price appreciation or super high absorption? And I think even now we're a little more steady, but I still think we're probably looking historically, we're still probably a little more on the seller's market than we typically are. So it's interesting to see how your business model and how your investment philosophy kind of shapes during these different market cycles.
Absolutely. And that is completely true, that we had some very aggressive sellers markets early in the pandemic. And this year is more normal than we've seen in the past. And it'll be interesting to watch things transpire over the next months, years, and I guess decades too at this point, because we live in a very dynamic city that is interesting in that sometimes the more things change, the more things stay the same. But without further ado, Taylor, you've dropped a lot of great knowledge on us already this episode as we've broken down the data. And for those of you out there, Taylor and I have the kind of friendship where sometimes we'll get in a situation where we're talking about real estate or we're talking about the market, and then we'll look down at our phones and realize the call's been for 2 hours. And it's happened a couple times now, but it's hard for me to like pick a moment in the conversation to say, okay, it's time to stop, just because the flow is really good and I am thinking and the wheels are turning and I'm learning at the same time, and it's very valuable. So just so everybody else has that perspective on who you are and what you've got going, Denzel and I want to ask you a bunch of questions about yourself. And I think the right place to start is tell us the story about how you got started in real estate and what drove you to do it in the first place.
So funny enough, a lot of people in real estate investors have their whole, I've been a big growth mindset, really ambitious, really trying to get as rich as possible. I kind of got into this because I was not happy with retiring at 50, 60, 70. I really wasn't the biggest fan of the jobs I had in the past and of where I think my life direction was headed. So I kind of got into this out of maybe laziness as opposed to ambition. I just really got into the whole financial independence movement and the whole idea of early retirement. Not that I'd stop working per se, but I just didn't like having the working with the gun to your head. So I started out, trying to, increase my savings rate, save as much money as possible, cut my living expenses, drive $1,000 beater, investing, saving my money, buying mutual funds, and that just wasn't going anywhere. It's really tough to grow capital when you don't have any. Always interested in real estate, and I just kind of I almost got sick of where my life was and decided I really needed to start pushing to go somewhere. I wasn't happy with how my wealth was growing or what my situation was. So I started learning as much as I could about real estate. I spent thousands of hours listening to every podcast and audiobook I could get my hands on, and finally just pulled the trigger and jumped in.
That's a really unique kind of situation for people getting into the whole real estate space in general. Although I do think there are a lot of people out there that find the whole financial independence aspect of real estate to be kind of paramount to their investing journey as well. And I am very curious. I have kind of two questions that I'm going to wrap into one question. Is when you made the decision that this was something that was important to you and that you wanted to pursue, who and what were the types of content that you were seeking out to try to learn more about that? And what made you select real estate as the vehicle to deliver the outcome that you desired as opposed to something else entirely?
So a big part of getting in real estate was just my skill set. I've been in construction since I was 17 years old. So I didn't have a background in, any kind of finance background or anything. So I kind of had to work within my own skill set. So buying and renovating houses always made sense to me. I know how to do it and I actually enjoy doing it. And then I essentially just almost every audiobook I can get my hands on. There's some, the classic Rich Dad, Poor Dad, a lot of Bigger Pockets podcasts, listen to a lot of a guy named Chad Carson, Coach Carson on YouTube. Really interesting. Almost the idea of not necessarily having to build big, but build efficient, try and maximize your lifestyle out of your portfolio. So I kind of ignored, I listened to some of the stuff, but I kind of ignored a lot of the 10x, grow as big as you possibly can, scale, 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 and kind of lean more towards the old school real estate strategy, buying good, solid homes, maintaining them well, and just building a portfolio that way. And, the whole idea of buy real estate and wait, I leaned into. So a lot of stuff I absorbed at the time was just kind of trying to piece out what I wanted to do. So I listened a little bit of everything, a lot of multifamily stuff, a lot of commercial, a lot of syndications, raising money, and I kind of settled on the investment strategy I've chosen.
I think that's brilliant. And for those of you out there, I've put a lot of thought into this, but everyone, I don't care who you are, you have some advantage over someone else somehow. And understanding what that is and leveraging it, and even going so far as to abuse your advantage to the maximum possible gain for yourself, is often the best way to get ahead. Because everybody can do something special. It's just you got to find out what it is. So I think that's really admirable that you identified your skill set. You found a way to use that for your own growth and good, and you're able to transition that into something that made a lot of sense. Also, I love the buy and hold and long-term perspective in your real estate investing. Now, a lot of people in our age range, guys, they think that the game of building wealth is actually something that needs to be done immediately because they see these people on Instagram like flexing their boats and their money and their rental foreign crazy sports cars that definitely aren't theirs. And they think, oh, I got to be a millionaire tomorrow, or like I'm a failure. And the truth is, no, most of the time, it's better to do this slowly and have a life that you're, first of all, going to enjoy. And second of all, be able to use those assets and those wealth for good, as opposed to just flexing debt on Instagram.
Okay,
So
hold on, guys.
love it. But yeah, why? Do you have a rental Lambo that you didn't tell me about, Denzel?
No, I
No.
I I just like for everybody to know whatever Taylor did, okay? I did the exact opposite. And Keaton's here saying, "Wow, it's such a great idea to do what Taylor did, and you should not do the what Denzel did, basically." And
I,
I just
okay, go ahead. But that
you
is
know,
not what I'm saying.
I know, but I just I go back to when Taylor, when you and I first met, sitting inside of Dominion, a rental property that I had Taylor work on, when I first started talking about kind of what we want out of real estate and what we're hoping to get. And I think you should be really proud of yourself for having the level of maturity that you did, Taylor, when you first started out. It's something that I thought that I had. And I think you did it the right way in terms of like how to build a portfolio. Because, I look at everything that I've accomplished to now and the resources I have available to me now. And the truth is that you could, if you have the right, uh, network and your marketing is on point, your deal flow is good, like you can build a portfolio in a year's time if that was your main goal. And I think there's a misconception about scaling 100%. I think that if it's going to be done, it needs to be done very carefully and responsibly. And yeah, I'm really, really happy to see where you're at, Taylor, because yeah, you've just done a really good job.
Hey, you too, Denzel. I remember that conversation pretty vividly. We were talking about what our net cash flow goals were. And I said, I want to make 10 grand a month. I think that'd be good. I'd be able to live pretty well, be able to enjoy the things I want to enjoy. You said, I want to make 100 grand a month. So from there, our strategy is kind of different. And I'm not gonna lie to you, I kind of got a little bit you get a little bit of the self-doubt coming in when I was doing, my 3 BRRRRs in a year and you're picking up 20. I'm like, oh, am I doing something wrong? Is this, am I not, do I not know what I'm doing? Why wasn't I raising money? Why wasn't I? So it's funny. We both kind of look at each other's strategies and go, oh, that really wasn't that bad of an idea. So there's more than
Yeah,
one ways to skin a cat, I guess.
totally. And I think the market also made a lot of people who started out in 2020 and 21 feel a lot smarter than they actually were, and so that's real estate for you, I suppose. But anyway, sorry to interrupt, Keenan. I just was sitting here smiling and laughing because I'm like, are they talking about me?
No,
No, I'm just joking.
that wasn't exactly the intention, Denzel. I think what you did actually was, on the whole, a good thing. You might have
Yeah.
taken it a little too far too fast, but not necessarily in such a bad way, because you could have borrowed money and done crypto pump and dumps instead.
Very
Like,
true. Very true.
it could have been way worse. And I didn't compliment Taylor as a backhanded slight at you. I've always appreciated the long-term perspective in investing, in life, in improving at anything. Like, in the background, you guys might see behind me here, I have archery medals. I have a world record on the wall. I have national records behind me, university degrees. My entire life has always been about focusing on a goal that's far away. And never once did I think, okay, I need to achieve everything by next year. It's
Yeah.
always an eventuality. And I just appreciate that he had the foresight to stop and say, okay, I know that when I forget the number, 55, 65, that I'm not going to want to work, or maybe I will, but not that hard, not gun to your head kind of like, hey, show up at the office kind of job. And for a guy that was in his 20s when he thought that, I don't know, are you even 30 now, Taylor? I'm not sure.
No,
But
I'm 28.
I'm 28. Okay. But to have that foresight 30 years or more in advance is is admirable. And that's not something that you see out of people on the street day in and day out. So props to Taylor, no slight to Denzel, but yeah, Denzel went about things his own way, and we've talked about that a lot on this podcast. And I do think ultimately it worked out. So
Yeah,
you
I
know,
basically fast tracked 10 years of real estate experience in like a year. And don't recommend that, but it is good because I do feel like now when I speak to anyone really, I speak from experience, you know, and I could speak to a guy who's in his 40s who hasn't done one deal, and the things that I have to say I know for a fact that are valid, you know, because I've been doing it for almost 5 years now.
and yeah, like you at also actually, are you even 28 yet? I think you are turning 28 this year. Don't
Yep.
remember. Yeah, that's right. Okay. So at 28, you have the life experience of somebody who's middle-aged from the
Yeah.
amount of business that you've done and the amount of deals you've gone through and the capital you've raised and the people you've interacted with. So I wouldn't discount all of that experience as something that's an error, because I would say that oftentimes it's making the mistakes that actually makes you better at stuff anyway. If
Yeah.
everybody was just perfect right away, then well, it'd be a nice world, I think, but truthfully, the way you improve is to fail and to do things wrong and to misunderstand and then correct. And you can't be great unless you make an error. It's just facts of life. You know what I mean? But
Yeah, I think we both made a whole lot of errors during the pandemic. I think we didn't realize at the time how much how overconfident you can get going into one of the craziest bull markets you've ever had, and you're just starting out. You really think you can take on anything, and that leads to some pretty questionable decisions. I think I've definitely made some in the past too.
Yeah.
and you know what? If you went and asked any person that was active in any financial market whatsoever about what they did during the pandemic and if they do it again, I don't think anybody would say, yeah, I do that exact same thing like over and over every time. Like I'm sure there are people that go, you know, it was really good at this point, but then by the time we got to this date, then all of a sudden my idea wasn't that good anymore. And that again, facts of life. Like people can get carried away, and that's okay. It's just you got to learn from it.
Yeah. Wise words from Keenan Brown.
Yeah. Well, thank you, Denzel. So let me ask you both. I know this is a Taylor interview, but I kind of want to hear Denzel's take on this question too. And this is something that I try to ask every investor guest that comes on this podcast. But just given the context of our conversation, I want to hear from Denzel's perspective too. What would you do if you got set back to zero? You have no properties, no capital, nothing, and you had to totally restart. How would you go about rebuilding your business from zero?
I'll let you go first, Taylor. I don't think I've ever asked you this question myself. So
Yeah, this is an interesting one because it's if I had to start from zero, and it sounds crazy, I almost would have built slower than I did. I think it would have invested a lot more time in building up my skill set and my knowledge, and also building up a whole lot more of a whole lot more cash reserves. Basically, having a way more solid. As much as I thought I had a solid financial position going into this, real estate's a really cash intensive business, and I think it would have spent a lot more time really gearing up in order to make more moves. I kind of stretched myself thin over a few years just trying to grow this thing. And that led to a lot of stress. And I think a lot of more questionable decisions where I wouldn't have necessarily made those if I had a whole lot better footing going in. So I'm not sure if I would have done anything super different. I probably would have picked up, maybe instead of picking up the $200,000 starter home, I maybe would have got a little closer to the benchmark price. Instead of going in St. James, I might have gone in Silver Heights, just that one step up in neighborhood. But it's really tough to say because it depends on when you're getting into the market. When we got in, it was pretty. I bought my first home in 2019 when things were really, really nice and steady. And by the time I really started going hard into investing, it was kind of a gong show out there. So it really was tough to make a really well balanced decision at the time.
Fair enough. And honestly, it's a good perspective to take. So you would have gone slower, gone for something closer to the benchmark price, ran the same sort of business, but just been more careful, had more cash on hand, etc. Denzel, any comments, and how would you go about things if you got totally factory reset back to zero, no properties, no capital, but you have the same skills you have now?
Well, before I jump into what like my take on it, I think Taylor, uh, just like Keenan just finished talking about, go like everything that we do is experience, and so whether we felt like we were stretching ourselves since, I honestly think that's just part of business. Like that is business. It's hard to make moves knowing what the outcome's going to be, because one could argue that you could have made those decisions and they could have been some of the best decisions you've ever made. And that's, I suppose, the risk in real estate. um, and a lot of the people who grow portfolios slowly, they might only buy like 6, 7 houses over a lifetime. And I think you have how many doors, Taylor? 10?
16.
16. There you go. So, and you think about, okay, I got 16 houses. I'm 28 years old. Like that's amazing. Like how many people do you know from before you got into real estate have that first and foremost?
No, that's true. You do have to take a good amount of risk to try and get well above where you probably
Yeah.
should be. You do have to take on some risk and a whole lot of stress and some sleepless nights, or else you kind of end up nothing wrong with it, but you end up closer to the average, right?
Yeah, like I think being young, we have the time on our side. In the event there are mistakes that are made that are arguably catastrophic, you still have an entire lifetime to correct those mistakes, right? So I don't know. I think because I too sometimes think, oh man, I wish I would have been slower. But in the same light, I wouldn't know nearly as many things as I do today, right? Like I wouldn't know how to, work around permitting and the different layers of construction. Like I lifted a house off of a foundation, like that was insane. I've changed sewer lines before. I've completely remodeled homes with only the framing done. Like that experience is like you can't teach that, like you have to go through that. And I think that for both of us, I'll just kind of piggyback off what you said. Yeah, I probably would have liked to go slower and had a more peaceful life. But I think there's beauty in the struggle that we all have in all of our businesses. And so yeah, that's just my comments on Taylor's thought on it.
Fair enough.
No, that's true. I think we all have a deal that we did. We went, oh boy, that sucked. But I probably learned more off that one deal than I did off doing 10 good ones, right? So
Yeah,
we've all. I think that's important to have.
it's just so traumatic, right? The one bad one, you're like, I don't want to do that ever again.
Yeah, I'm gonna buy a vacant, fire damaged fourplex. It's got squatters in it. Here we go. I'm gonna get rich.
Yeah. Okay, so I guess my Keenan, I'll answer the question. If
Yeah,
I
go for it.
if I had all of the skills I have today, the network, everything, and I lost absolutely everything, I would I would probably focus all of my time and energy towards building cash. And so if real estate specific, I'd probably wholesale and flip houses actively, very aggressively, until I built up a nest egg large enough where I could buy a rental property, be that a duplex or a triplex, but turnkey. So, let's say one of those really nice 2-story secondary suites in River Heights for 650. What's 20% down on that, guys? I can't do the math right now.
It's going to be about 175 grand.
All right, so let's say I flipped 5 houses and I made a quarter million. I'd take 170 and I'd put it into that. And then I would sit on that and I would just keep doing that for maybe 2 or 3 years and maybe get up to 5 duplexes or something like that. And then just see how I feel after owning 10 units. And if I feel like the buy and hold space is kind of where I'd like to be, because I do enjoy flipping houses. I like to see the transformation. I like the financial outcome that is possible in those deals. And that's probably how I would uh, start over, flipping and wholesaling first, and then buying the rentals after.
Good answer. Good answer. Good answer. So there you go for you listeners out there. Both of these guys have the idea that they would like to start a little slower and then focus on building cash positions and turning it into high quality long-term holds. And I think there's a lot of wisdom that comes with that. Now, Taylor, in our private conversations, you and I have both talked a lot about diversification and the importance of diversification. So in your own personal life and regarding your personal finances, how have you managed to diversify both your real estate portfolio and your personal portfolio for you and your family? And talk to me a little bit about the factors that influenced your decision to make those decisions in the first place.
Well, tell you the truth, I started out with a good diversification mindset, and then I pretty much dumped everything into real estate, just going against all my principles. And then started to realize kind of the inherent risk in real estate investing, even buy and holds. There is, if you want to run a successful rental portfolio, there is a lot of ongoing maintenance, whether it's actual repairs or it's preventative maintenance going on. There's a lot of CapEx items. There's a whole lot that can go on. And it can be pretty cash intensive. You don't know necessarily when you'll have a bunch of things go wrong. You'll vacancy come up. You have a BRRRR, a flip project that goes long or goes over budget. You have problems with the city, whatever happens. And you start realizing that to be successful in this game, you have to be in for the long term. And that means not losing your shirt on a bad deal or if the market changes or something. So when I started seeing the risk that some other people were taking, not just in real estate, but also in whether they're going all in crypto or whether they were, riding out, hoping that their really good paying job is going to last forever and living to the, spending every last dollar, I started getting back a little bit to the diversification and being able to stay in the game for the long term. So for me right now, it's essentially one of the best returns I can get is just paying down debt. I have some mortgages on rentals that are above 6%. So if I can pay down principal on that, that's better than any bond I'm going to get. So stuff like that's interesting. Also just holding a bigger cash position, just to be able to weather whatever storm comes up. I want to have a whole lot of cash reserves, more than I would have ever thought was reasonable. Just seeing how this business can go, you really realize you can never have too much cash. And then from there, I'd like to have a fully separate investment portfolio that I'd like the real estate to be able to fund itself, have that grow independently of my own income, and then start building up. I mean, we have a great investment vehicle in the TFSA here. So I think everyone should at least have the TFSA maxed out. If you have some income tax problems, maybe look at RSPs, just stuff like that, where you're not necessarily living and dying by your flips or your wholesales or your rental income or your whatever it is. So to me, that's the important part that I've gotten to at this point, is just not putting myself in a position where you can go to zero. And then from there, it's going to be essentially trying to build up something that's at least inflation resistant, which I think rental properties can be. But it's just building something that even if the real estate all goes, because we're still dependent on, if we're investing in Winnipeg, we're still dependent on the Winnipeg market. Things could go, I don't think they will, but things could go really sideways in Winnipeg. And we could end up with, to no fault of your own, you could lose a whole lot of your property value. I don't think it's going to happen, but diversification outside of this asset class or outside of this city or outside of this country even, I think is really important.
I think that's a really, really solid and comprehensive answer. And I think you're the first one on this podcast to bring up the fact that there are non-real estate investments that you personally make. And I find that pretty interesting because we're at episode 10. We've had a fair share of guests and, some people we didn't actually directly ask that question. But I think a lot of real estate investors should probably realize that if they have millions and millions of dollars worth of property in a singular city, often in the same area, with very large mortgages on a loan to value basis on them, that they might be taking a risk that they don't fully understand. So with that in mind, would you ever consider purchasing real estate in other faraway cities? I'm not talking about like Brandon and Portage la Prairie. I'm talking another province, or maybe even the United States?
Not the United States. It's something we look into, but spend a lot of time in Mexico. I try and get away for as much of the winter as possible. And we go to Puerto Vallarta, which is a beautiful, vibrant city. It's got some pretty high real estate prices, but I'm looking into purchasing kind of a small multi-family there where we can live in a unit when we go down there in the winter, rent it out. There's a lot of short-term rentals there. The cash flow is actually really strong. The mortgage market in Mexico is a little bit tricky. If you can get a mortgage, it's typically at a pretty high rate. And then also you have to worry about currency exchange. If you get a mortgage in pesos and you're earning Canadian dollars, there's a lot to consider there. So it might be a save up and pay cash. But I'd love to get a property somewhere warm in a country that I think is a lot of potential where I can, get away to in the winter. I also think it'd just be a good, even lifestyle hold, not even necessarily just as an investment, but that's something that really interests me. Apart from that, I've looked in the US. They have some really attractive mortgage options, but it's been Mexico has mostly been my focus lately.
It's interesting that you say that. I'd love to put you in touch with Guy Boudreau, my dad, who was on episode 3 here of this podcast. He actually owns property in Mexico like you're describing. And I think connecting the two of you would be an interesting conversation because he's owned that unit for quite some time. And he does exactly what you described, where it's a rental most of the time, but then he uses it as a vacation property on the side, but it's incredibly cash flow positive. And he also had to navigate the challenging mortgage dynamic and the currency issues that come with owning foreign real estate, especially as a non-resident and non-citizen of the country that you're owning the thing in. And
yeah, that'd be great. I'd love to talk about that because it's interesting, but there's a whole lot. It's almost like learning real estate all over again, learning a whole different country and how everything operates there. So I'd love to talk to anyone who's had experience in that area.
Absolutely. I think that's definitely a connection that we should make here. I think Denzel stepped away, so I'm just going to move on to the next question here. But I wanted to give a little bit of your background beyond just being a real estate investor. Is for those of you who are unaware, Taylor is also a licensed Red Seal electrician. And because of that, as somebody that works on, first of all, your own properties, but also, as far as I understand, you do work for other investors on their properties as well, where required. Is that correct?
Yep, that's correct.
Yeah. Okay. So let me ask you this. You have a very unique perspective on the entire real estate investing space. And when you're undertaking a project of your own, do you actively try to make it the case that you do as much work as possible that you're physically capable of personally executing? Do you take more of a GC role in which you hire out a lot of the trades but you're overseeing it? Or do you like to go hands off on your own stuff?
On my own stuff, in a perfect world, I'd love to do everything myself. I really enjoy the building the skills and all the stuff I've learned over the years of being able to take a property start to finish. It's very rewarding to be able to do something with your own 2 hands all the way through. But that doesn't always make the most financial sense. You're holding costs involved in that. Obviously, if you're doing a big reno, you have the vacancy involved, and it can really start to take a whole lot of time to do a reno. So in my own projects, it depends on obviously my availability and the timeline. And on other people's projects, I tend to take more of a GC role where I'm just managing sub trades. I have a great group of sub trades where I can get projects done really well with really qualified guys. But again, the perfect world, I actually really enjoy doing the work myself. It's just doesn't always make the most sense financially.
Right. And that makes a lot of sense. And I guess if you could save a little bit of money and keep your costs down by doing the work, then I mean, why wouldn't you? But I also know that as somebody that has quite a large portfolio and often a lot on the go, that's not always so easy. But I'm glad that you make it a priority to be able to do your own work and to, when you have to go and work for somebody else or work on their own stuff, that you have the circle to be able to GC out a lot of the work that is in there.
Yeah, especially with investors, their timelines are typically they typically want to get this thing turned around yesterday and for as cheap as possible. So in that case, you kind of have to work with what their idea is. As opposed to my own project, I'm a lot happier I'll spend a little more money, I'll spend a little more time, I'll address things that wouldn't necessarily get addressed by a flipper or a typical investor. So it's a different type of project when it's my own house that I now have to own and maintain for the next 20, 30 years than it is for somebody who's trying to get in and get out as fast and efficiently as possible. So you almost have to have two different strategies.
Yeah, that makes perfect sense. And I think that that is a unique advantage to somebody that is going to hold for longer than a little bit. It's tough to be in and out of properties. Like to flip real estate or to trade properties in any way is very taxing because obviously the carrying costs are high. But other than that, every month is possible changes in the market, and you're taking market risk every second that you're not sold. So I love that you're able to address stuff that wouldn't otherwise be there just based on the business model. Very good.
I think it's tough too in our city. Our housing stock is so old that it's really tough to go in and know exactly what you're going to do for reno, know exactly what's going to come up in terms of potential issues. It's I think it's really tough to be a flipper in this market, or even to be any kind of buy and fix investor, because it's really tough to get a bang on renovation budget without a big contingency for what can go wrong in some of these products, especially the typical age of a house I'll buy is in 1918, 1914, 1910. So without x-ray vision, you really have to go in knowing that things will come up.
Exactly. And as much as it would be nice to be able to go and put together a totally accurate scope of work and a flawless budget for whatever it is that you're buying, I, as well as anybody, understand that those are still estimates, and they can be wrong sometimes in a big way. And for home buyers out there listening to this, I just want to add too that like investors aren't immune from making mistakes, and they can get surprised too. And just because, oh, well, if you would have hired a home inspector, you would have found it. Sometimes, home inspectors are just humans. They don't have x-ray vision. They have tools to look at stuff, but they can get caught too. And that's part of the risk of the business. And that's why when you purchase property, you're taking a chance, and there has to be a profit margin for taking the risk of the acquisition. So glad you recognize that. Yeah. Now, we've talked a lot here about how real estate is such a long-term thing for you and your own business. But I would say, as an agent and somebody that works closely with a lot of investors, I both feel and see the short-term taxation that can come with dealing with this industry on a day-to-day basis, because let's be honest, it is a lot of work and it's not always easy, although I guess sometimes it can be, but those days seem more rare than common lately. What do you do on a short-term level to keep perspective, to stay sane, and to have an eyes on the target, goal-oriented focus for the long term in your own business, in your own world?
I wanted to get we've never actually talked about this. I wanted to get your take on it, because for me, a lot of it is avoiding burnout. A lot of it's just avoiding where you're really fighting against it for a long time. I find that doesn't do you any good in business, but you really sometimes can avoid it. When the phones ring, when you have people that need stuff, when there's timelines you have to meet, it's a tricky one to try and balance your own personal sanity and your own personal, trying to take a day off here and there against the demands and pressures of the industry. So what do you do?
Well, for me, I'd say a few things. So if I'm in a situation where I'm incredibly busy, it's very easy to just have every single day booked start to finish. And there's going to be bursts where there's nothing you could do about that. You just have to grind it out to the end. But when I eventually have a moment, and there will always be a moment, there will be a long weekend where people just don't want to deal with you. There will be Remembrance Day where you can't do business anyway. There will be situations where there's just going to be a quiet day. I try to make sure that there's one day that I can look forward to where it's like, okay, today I don't have to do real estate. Now, somebody's still going to call, somebody's still going to text, somebody's still going to want something at some point, and that is okay. I signed up for that. But I try to make sure that I eventually get at least a day's break. And truth be told, in the spring, way, way easier said than done. In the summer and fall, it can happen. And sometimes you get a full day on the weekend where it's like, look, I'm going to call some people and I'm reply to some texts, but that's it. I'm not going and open housing. I'm not going and showing 10 homes today. And I'm not going and listing property and recording videos and making content and doing this, that, and the next thing. So I basically, what I do to avoid that burnout and to keep that long-term focus is I find little micro breaks to just slow things down. And towards the end of the year, at least on the agent side, there's some seasonality to the industry from my own business perspective, where I'm going to be a lot less busy in Q4 than I was in Q1. And that little break gives me an opportunity to re-energize for the next calendar year. And then it's pretty much a sprint from January 1st through to the end of May. And then you taper down and you kind of walk it off into the fall, et cetera, where things naturally, just on a business cycle basis, slow down a little. I hope that accurately kind of captures a reasonable answer here, but is that similar to what you do?
Yeah, it is. It's sometimes tough to go from being Keenan the realtor to just being Keenan the human, right? You kind of always have to keep that hat somewhere close, right? But one thing I found too is trying to outsource a lot of the things that I'm really not good at or that I really just can't seem to stay on top of. I'm a typical, blue collar guy. I have a terrible time with keeping my books, right? So I'll end up with a big giant stack of receipts and oh gee, I gotta try and consolidate everything. So having a really good bookkeeper, having good accountants, having the people on your team that are able to do the things you're bad at helps a lot because I will get a lot less burnout doing things that I enjoy and doing things that I find fulfilling than I will doing the mundane things that are involved in this business.
Well, good. I think that's a smart thing that you added, is outsource where possible, because it sounds so simple, like such a common sense thing to do, but so many people forget that you can do that. And the fact that it's just like, hey, keep it simple, like invest for the long term, outsource the stuff that you can't or you don't like to do, makes a lot of sense. I like that answer.
Yeah. I think for me, to how do I unwind and kind of take breaks and things like that? I think it kind of happens periodically through the week where it might not be an entire day, but it might be like a purposely blocked off period of the day where I just don't work. Like for example, like most typical work days are from 9 to 5. And I really try to at 5 o'clock put work down and casually work because it's impossible to not, right? And so from 5 to call it 9 p.m., I try my best to fill that with time with family and, or extracurricular things. Like I play a lot of basketball still, I coach basketball and doing things outside of real estate helps me reset for the following day. So yeah, I think I had to adjust to that because the first few years of business was extremely chaotic and busy, and I didn't know how to manage my time super well, and I'd get stressed out if I wasn't doing something. And so now I've kind of been able to be more at peace with just, okay, it's I did a lot today and I know that I'm not going to get everything done on my list, and being okay with that, and then just kind of taking it from there and just picking it up where I left off the following day after.
And good, like for those of you who are in a position like Denzel, where you've got a young family and a kid under one, or maybe actually just over one now, pardon me, but you're never going to get a full day like that, especially when you're as busy of a guy as he is. So you don't need the full 24 hours. Take micro breaks, put an evening off and spend time with your family, or do whatever you got to do to relax and unwind. And I think that that's the way to win in the long term, because real estate's not a sprint, it's a marathon. And if you burn out and you can't work effectively for the next 6 months because you're so psychologically fried, you can't look at a deal properly, and you start making mistakes, it's going to cost you a lot more than taking an evening off every so often where you really need it. I'm going to move on to the last question here for you, Taylor. What is your grand ambition for your real estate venture? And at what point do you think you would be able to confidently say, I have achieved what I set out to achieve?
It's funny because that changes all the time. The direction stays the same, but when you're in real estate, if you get the bug, you're in this. You know, it's really tough to say. I'm just want to. My goals have changed as I've done more and more. Right, I can see myself just continuing to do bigger and bigger things because I enjoy it and I love doing it. I don't think there's ever going to be a time where I can sit back and say, oh, you know what, I accomplished what I set out to accomplish. I think that goal is just going to change. I'm sure it's the same way for both of you guys, where it's really tough to just be satisfied or to have, oh, I achieved this goal. I'm just going to, hang out now. I think that, being as young as we are and in the direction that we're going, I think that's just going to constantly evolve. So, how about you, Keenan? You think you have a goal where you can just stop, or do you think you're just going to continue to grow and have that, finish line just keep moving?
Well, it's funny you should ask because I did for a long time have a goal where I said, okay, if I could just get to like I'll list the arbitrary point that I kind of set in my mind, then I'd say then I have won. But now that like I'm very close to that, it's like, okay, I have a lot more things that I want in the future now. And probably even when I get there, it still might mean that there's more to be done. And I think, whoops, bumped my microphone there. I think once I get to a certain age, those goals are going to be a lot less about kind of financial milestones and business accomplishments and achievements in that sense, and it'll be more about family and time. Like my first milestone that I thought I would really like to get to was be married, which I am, to my wonderful wife Celia, who is I think still asleep. I'm not sure. Uh, I want to have kids. I wanted to have my own home and be financially stable and be able to have the ability to work without feeling like I was a slave to my own operation. And almost there. I don't have kids yet, but soon enough, I'm sure I will. And so what's next? Well, I have business ambitions now, and I want to scale up and be able to be profitable as a realtor or in the industry in one way or the other, whether that's actually through transacting and being an intermediary or an investor myself or just whatever, something like that. Grow to the point that I'm able to generate a lot of capital and provide for my family for the long term. But then I think about when I'm 45, 50, 55 years old, my kids are going to be high school aged or older. What are my priorities going to be then? It's probably going to be time. And at that point, I'm definitely going to be in a position where I'll want to have as much time as possible to spend with the people that I love and do the things that I love to do. And that will be the ultimate resource and the ultimate direction of things after that. And if I can get to that point, I'm pretty confident at that age, I'll be able to say, yes, I've achieved my grand ambition. And now I can enjoy the rest of my life without worrying too much about anything, regardless of how much money I have.
Yeah, that's smart. I think at some point the money becomes arbitrary compared to the time, right? You obviously need the money to get somewhere, but then at a certain point your time becomes way more important. And then you have to kind of start looking at, is getting this bigger net worth or raising this income or doing this new business venture, is this actually gonna get me my end goal, which is my time and the ability to do the things I want to do, spend time with the people I love, that kind of stuff.
Exactly. And that's a lifestyle thing. But in our late 20s, early 30s, you need to take some steps first to get there because we're all either entering or in our prime earning years. And we need to make the absolute most possible out of this next at least 15, if not 20 years for kind of all of us here. And I think we're all on a really good path to that. But Denzel, I'm actually curious from your standpoint. I know we've kind of had this conversation privately a few times, but I do want to hear your thoughts on this.
I think just like the both of you, goal setting and where I'm hoping to land in terms of my just my over what I'm trying to accomplish with real estate and things like that. It I really like work, just plain and simple. I actually enjoy working. I think that it's something that keeps people alive, to be quite honest. Like my grandpa, he's in his late 70s right now and he still works. And he says to me that he couldn't see a life where he didn't like go to work Because what else are you going to do? You're just going to sit down and just watch the days go by? Probably not, right? And so I think maybe it's a certain point in my life I'll probably pivot and work less, but I'll never actually put the phone down, I don't think. Guy is a prime example of a person who's already accomplished amazing things in real estate here in Winnipeg and still chooses to work. And so, like you guys, I think time's super important now that I have my daughter and, we have conversations, my family, about having more kids. Yeah, like I'd like the time to spend with my own parents and just family and overall. And I think having enough money uh is how I'm gonna be able to do that. And more importantly, I think I know now what amount of money I'm going to need to live the life that I want. Because before I was like, man, I want like $100 million, like just insane amount of money. And now I'm like, well, if I lived in Winnipeg, I bet you I could live a pretty good life with like 300, 350. Like you could get a nice place, you could have a nice car, you could go on the vacations and everything's taken care of, you know? And you do have the freedom of choice at that point, in my opinion. So, yeah.
True enough. True enough. True enough. And time is it's funny. We talk a lot about perspective and long term versus short term, and it all comes back to time in the end. So use your time wisely, folks listening at home. We're running pretty long here, but this has been an awesome discussion. I've had a lot of fun recording this, and I hope you guys listening have had a lot of fun listening. But I want to take this opportunity to let Taylor either make any comments or say anything that he would like to say, or alternatively ask Denzel and I a question that he would like to have us answer, although he's already done that a few times this episode. So Taylor, I'm going to turn it over to you. Any closing thoughts or questions for Denzel or myself?
You know what? I know we're running long here, so we'll see if we can keep this short. I just wanted to see a big part of our investment philosophy is buying in areas in the path of progress or in areas that have a big opportunity for improvement. We've definitely seen this over the years in Winnipeg. Areas have gotten better and worse, and especially areas like significantly below the benchmark price. So I want to hear both of your guys' takes on what are some areas, if you were to buy and hold lower price, let's say there's single family homes. Are there any areas that you look at that have that upside opportunity that maybe are on the fringe of being rough, but that you see improving on a year-over-year basis?
I can start with that, and I would say absolutely yes. And the big trend that I've seen personally is some of the areas that formerly would have been somewhat stigmatized or were maybe the second rate area to the neighboring area that was considered really good, like the Westdale to the Charleswood, or the East Kildonan to the North Kildonan, or the West Kildonan to the Garden City kind of thing, or even to some extent the four C's of the world. Okay. I think there is a lot of merit to buying in neighborhoods like that, where they're nearby a very desirable neighborhood where people want to be in general, but they're not quite there. It's everybody's second pick. Now, I also am a big fan from a buy and hold perspective of looking for areas that are full of properties built between 1950 and 1979. I think that those areas were purpose built to be suburban. They're designed in logical and thoughtful ways without streets being too chaotic or difficult to navigate. The construction quality is good and unlikely to create problems. The products are desirable and conventional in such a way that they remain liquid in virtually every market, good, bad, or ugly. And often they're priced really close to the benchmark and sometimes even just under. So my focus would be on areas like that. And if we're talking about MLS area codes specifically, I think even something like Tyndall Park, both east and west, are really good options. I think like we talked about Valley Gardens a little bit, and we talked about East Kildonan a little bit. Those are really, really good picks as well. Something like Meadowood or 2E in the St. Vital area, just north of River Park South, another excellent choice. Those sort of neighborhoods are premium picks. 5H, Crestview Heritage Park, 5F, Silver Heights, very near to Westwood. Awesome selection. It would be those kind of areas that I'd be looking for. I'd be seeking out conventional products, probably bungalows, about 1,000 square feet, 3 bedrooms, and that's what I would hold for the long term.
Yeah, it makes a lot of sense.
Obviously, it takes more capital to get that kind of thing, and that's not necessarily possible for everybody. But if we're playing a perfect world investment philosophy, that would be my top choice at this point.
So you're just looking for areas in close proximity to a super desirable, higher price area, right? Where someone might say, "Oh, I can't afford Westwood. Maybe I'll look at a Crestview or something similar to that."
Exactly. That's precisely right. Denzel, I want to hear what you have to say about that.
Yeah, like I would say areas like Lord Roberts, like what Keenan just finished talking about, the areas like that are second to the more desirable ones. I think Lord Roberts is kind of like feels like has a River Heights aesthetic, but is far more cheaper.
Yep.
Crescentwood also is an area that's like River Heights, but actually has newer construction in the area, like 1940s and 1950s stuff. So I think if anyone is looking to get into areas that are transitioning, because I think that's what you're uh alluding to, Taylor, I would probably say like Brooklyn's area, like anywhere where the price point right now is under 300, where you can get into the area is somewhere that I'd definitely consider. Because Winnipeg is growing and it's growing fast. And I say this quite often to people, and it's that the minute that Winnipeg becomes a city that has 1 million people in population, the housing price is going to be unrecognizable to where it is today. My opinion. Like, you think about it, city like Calgary, where the benchmark price is like 550 grand, and you're getting like 1,000 square foot bungalow that needs work. Like that's Calgary real estate. Here in Winnipeg, you could still buy that under 300, surprisingly. Hell, you might even be able to find it under 250 in the right area. So
True enough. And when it comes to those high growth opportunity areas, like as we've talked about, 5D is a really good example where that area has really turned around in the last 10, 20 years. The Elmwoods of the world are similar, where like 3B and 3A used to be like honestly kind of rough. And now totally unrecognizable. Like if you had left Winnipeg in the 90s and you came back and you were walking through 3A and 3B, you'd think you're in a different city. And that trend might continue, might not, I don't know. But I would say that would be a really good opportunity, like buying in those areas that are close enough to something good, but not part of that same area is probably a really wise place to park money for the long term.
Yep, I agree.
So any comments on any of that, Taylor? Is that a good enough answer for you?
Yeah, that's great. I just like hearing. I know you
Good
guys are
enough
both
for
very
you,
active
Taylor.
in the market. Yeah. Well, I got about 50 market regions here to look at now. So, but no, it's just I know we've all paid a whole lot of attention to the city. I think we're all pretty knowledgeable in terms of just the layout and the demographics and the age of construction and house prices and the amount of properties that are rentals versus owner occupied. So it's just interesting hearing other people's opinions on where you think the growth is heading and how you think that's going to look as our city does grow and as we hopefully have things like our new infill guidelines and better rapid transit and stuff like that, and seeing how our city's going to change. And hopefully you can just get right in front of that and ride it up.
Yeah. And that would be that again. I really look forward to one day in the future coming back and reading market updates from years ago and listening to podcasts from years ago and just seeing either how right or how wrong we were. And I think that that's going to be a fun activity in 2034 to 2035 market season. Maybe I'll even republish. Yeah. So if you're listening in the future, hi from the past.
There you go.
Yeah. That'll be a fun treat for one day in the really long term away. But Taylor, this has been a super fun conversation. I want to sincerely thank you for joining Denzel and I here today on this episode. You brought a lot of really unique and cool perspectives. You're always great to converse with, and I would love to have you back on here again to join us sometime in the future.
I really appreciate you guys having me on. Long time listener, first time caller. Really, I think you're doing a great thing with providing this kind of content. So I just really appreciate what you guys doing. Thanks for having me again.
Awesome. Well, for those of you listening, stay tuned. We will be back next month with another awesome episode. And I want to say thank you all for listening. Remember to subscribe if you haven't already. And have a great day, everybody, and enjoy the month of October.